Okay, so what if I told you that the secret to preventing the next big bank collapse isn't hidden in some complex financial model, but actually in the cockpit of an airplane? It sounds a little out there, I know, but today we're going to unpack the sudden failure of Silicon Valley Bank to get at a much bigger problem in finance. And believe it or not, the answer might just be flying right over our heads.
I mean, this is the question on everyone's mind, right? Another bank collapse. Seriously? After everything that happened in 2008, after all the new rules and regulations, how are we here again? It wasn't supposed to happen. And the fact that it did, well, it tells you there's a major critical gap in how the whole industry thinks about risk.
See, here's the thing. Picking apart a failure after the fact, that's the easy part. Anyone can be a genius in hindsight, right? The real challenge, the part that actually matters, is seeing the risk coming and doing something about it before it all goes wrong. And as we're about to find out, the story of Silicon Valley Bank is a textbook example of, well, not doing that.
All right, so to really get what happened here, we've got to look at the anatomy of this collapse. It was truly a perfect storm of events. And look, nobody could have predicted the exact way all these things would line up. But the ingredients for the storm, things like inflation, rising interest rates, those were absolutely known risks, just kind of bubbling under the surface.
So let's walk through this timeline, because it's like watching a set of dominoes fall, one after another. You start back in 2020 and 21, interest rates are basically at zero. So banks like SVB are thinking, where can we get a safe return? They pour billions into what everyone thinks are super safe, long-term government bonds. But then, bam. Global instability, inflation goes through the roof, and the central banks have no choice but to slam on the brakes and hike interest rates like crazy. And just like that, those safe investments, they suddenly became a massive ticking time bomb.
And that time bomb led directly to this, a classic catastrophic asset-liability mismatch. Let me break that down. On one hand, you have the bank's assets, all those bonds they bought. When interest rates shot up, the value of their old low-rate bonds just cratered. But on the other hand, you have their liabilities, which is basically the money their customers deposited. And at that exact same moment, their customers, a lot of them tech companies, all wanted their cash back at once. So the bank was forced to sell those now worthless bonds at a huge loss. A problem that was just on paper suddenly became a very, very real cash crisis.
But let's be crystal clear about this. This was not just bad luck. You can't just blame it on the perfect storm. What those outside pressures really did was shine a giant spotlight on some really deep internal failures. This was a failure of imagination, plain and simple, and a failure of management.
And this really shows you the brutal squeeze they were in. It's like a financial pincer move. On the asset side, their bonds are just plummeting in value. On the liability side, their customers are demanding their money back like right now. They were getting crushed from both sides of the balance sheet all at once. There was just nowhere to hide.
And when you dig into the details, it gets even worse. These weren't tiny little oversights. I mean, come on, they had no hedge on their bond portfolio against rising interest rates. That's basic. They went for 8 months, 8 critical months without a chief risk officer. And maybe worst of all, their own internal tests basically said, oh, a scenario like this is too rare, don't worry about it. They just dismissed the very thing that ended up killing them. It's a shocking failure of imagination.
And that's the real kicker, right? The combination of events might have been rare, but the ingredients themselves, a jump in interest rates, a run on deposits, these are not new ideas in banking. They are known risks. So this was just a classic case of completely misjudging the risk, or maybe even worse, just missing it altogether. It was staring them right in the face.
Okay, so how do we stop this from happening over and over again? Well, the good news is we don't need to invent some brand new solution from scratch. We just need to look up, because there's a completely different industry that has already mastered the art of taking extreme life or death risk and making it incredibly safe. I'm talking about aviation.
And the numbers here are just mind-blowing. A 77% improvement in safety in just 20 years. I mean, stop and think about that for a second. We're talking about flying in a metal tube 7 miles up in the sky. It should be the riskiest thing we do, but they've managed to make it the single safest way to travel, period.
So how in the world did they pull that off? Well, it all came down to a huge shift in mindset. They stopped just being reactive, waiting for a crash to happen and then figuring out why. Instead, they got proactive. They built this entire culture around preventing accidents from happening in the first place with things like mandatory training, strict decision-making rules, and sharing data across the entire industry.
Okay, and this is where we connect the dots.
Because those exact same ideas that keep airplanes safe in the sky, we can apply them directly to finance to build a way stronger system. It's really about shifting from thinking about financial engineering to thinking about safety engineering. And this table just lays the difference out so clearly. It's like night and day. Look at training. In finance, simulations are kind of limited. In aviation, mandatory flight simulators. Analysis? In finance, it's optional if something goes wrong. In aviation, mandatory public investigations. Decisions are left to individuals in finance, but in aviation, they are forced into a structured process. And data? Finance keeps it siloed. Aviation shares it with everyone. It's a completely different philosophy. One is about protecting the firm, the other is about protecting the entire system.
And one of the coolest tools they use is this thing called aeronautical decision making, or ADM. The easiest way to think about it is like a checklist, but for your brain. It forces pilots to work through a consistent, logical series of steps before making any call, especially when things get stressful. The whole point is to take gut feelings and panic out of the equation and replace them with a reliable, repeatable process.
So, putting it all together, here's a 4-step blueprint for making banking safer. Step 1. Mandate realistic crisis simulations. Put bankers in the financial equivalent of a flight simulator. Step 2. Force public investigations after every failure. The lessons have to be learned by everyone, not just swept under the rug. Step 3. Implement structured decision-making, just like ADM, to help people make better choices under pressure. And finally, Step 4. Aggregate data. Create a system where banks share risk data so we can all spot systemic threats early.
So, when you boil it all down, there are a few huge takeaways here. First, you can never, ever ignore a rare scenario just because it's unlikely. Because guess what? The unlikely happens. Second, having a strong risk culture isn't just a nice little bullet point in a corporate brochure. It is non-negotiable for survival. And finally, maybe the biggest point of all, we don't have to reinvent the wheel here. A proven model for making things safer already exists. We just have to be willing to learn from it.
And that really leaves us with the final big question, doesn't it? We know that the true test of managing risk isn't how well you analyze the last crisis, but how many future crises you prevent from ever happening. The blueprint is there. It's proven. It works. The only question left is, will the industry actually use it?